Hello, I'm Ian Pocock, Global Editor at Base Oil News. Today we're looking at the relative strength of base oil values versus feedstock and competing fuel prices in recent weeks. Base oil values often weaken relative to crude and diesel around year end and the start of the new year because of weaker demand and rising surplus supply. But base oil values versus feedstock and diesel prices were steadier than usual late last year and at the start of this year. This slide shows the base oils premium versus VGO and gas oil in Europe, US, and Asia over the last 2 years. It shows the recovery in the base oils premium since the end of the third quarter of last year, and then those premiums holding firm into the start of this year. The question is, why have base oils values been firmer than usual at a time of year when they often fall? A look at supply-demand fundamentals provides some clues. This slide shows the change in quarterly lube demand from the previous quarter, from the start of 2023 to the first quarter of 2024 in Europe, Asia, and Latin America combined. A projected increase in lube demand of around 300,000 tons in the first quarter of this year from the fourth quarter of last year would be similar to the size of the rise in demand in the first quarter of 2023 from the fourth quarter of 2022. This time last year, blenders globally were focusing on working down high inventories. The move muffled the impact of the rise in finished lube demand in the first quarter of 2023. This year, blenders stocks are lower. So the effect of a seasonal rise in lube demand in the first quarter could translate into an earlier and stronger pickup in base oils demand than it did at the start of 2023. On the supply side, global markets typically face a large rise in surplus volumes at year end and the start of the new year. What about the end of 2023 and the start of this year? There are signs that the surplus could be smaller than it was last year. This slide shows the premium of CFR India Group 1 SN 500 prices over FOB Asia prices. The ICIS data shows that the premium fell from November 2023 to its narrowest since the beginning of last year. The strength of Group 1 prices in Asia relative to other markets reflects tighter Group 1 supply in the region. Group 2 supply in Asia was also less plentiful in the fourth quarter of last year because of maintenance work at Taiwan's Group 2 plant throughout the period. In Europe, the arbitrage to markets like India and the Middle East Gulf stayed shut. The closed arbitrage points to still limited surplus supply in Europe. There has been more surplus supply to clear from the US, but an open arbitrage has enabled it to clear a large volume of that supply. This slide shows the premium of India light-grade prices over US prices. ICIS data shows that premium improving during the fourth quarter of last year, after India prices fell to a discount to US prices during the third quarter of the year. The open arbitrage enabled a steady flow of US shipments to move to India and to cut the size of the surplus in the US market. To be sure, the global market remains structurally long. But at the end of last year and in the first few weeks of this year, supply and demand fundamentals show signs of being firmer than they were at the same time a year earlier. That suggests that the steadier base oils values versus crude and diesel may in fact be reflecting those firmer supply-demand fundamentals. Many more in-depth discussions about the state of the supply-demand fundamentals will be taking place at the ICIS World Base Oils and Lubricants Conference in London in early February. Thank you, and we'll look at more market and price developments in the base oils market over the coming weeks.